Welcome to the Deep Dive. Today, we're taking a journey, really, into finding value, finding that passive income stream in the financial world.
Yeah, that passive income everyone's looking for.
Exactly. And we're going to zoom right in on real estate investment trusts, REITs. Those companies specifically set up to pass income through to investors. Our mission today, to really pull out the key takeaways, the important nuggets about some specific high-yield players in the REIT space.
That's right. And REITs are, well, they're particularly interesting for dividend investors, aren't they? Because of that structure, it often means higher payouts.
Right.
And then, as the sector's grown up a bit, certain companies really stand out, not just for income, but maybe some growth, too.
Okay.
So today we're going deep on three dividend giants, you could call them, leaders in their own fields. Prologis, Realty Income, and Simon Property Group.
Got it. And for you listening, the goal is simple. Understand what makes each of these tick, their unique strength, so you know why one might appeal more than another. Okay, let's unpack this then, starting with Prologis. Now, this is the big one in industrial REITs, the largest.
It is, yeah.
But my first thought is, okay, the dividend yield, it's just 3.8%. You see that number, and maybe it doesn't immediately shout high yield, especially next to some others.
Yeah.
So what's the real story here? Why is 3.8% actually interesting right now?
That's a really good question because context is key, isn't it? So 3.8%, yeah, maybe it sounds moderate, but compared to the S&P 500, that's way above the index is what, 1.3% yield?
Oh, definitely. Big difference there.
And maybe more importantly, look at Prologis itself. That 3.8% is actually near the high end of its own yield range over the last 10 years or so.
Okay. So high for them and high relative to the market average. Suggests maybe it's a bit cheaper than usual.
Could be. It suggests maybe the stock price hasn't kept pace with the dividend, offering a better entry point yield-wise.
Gotcha. Now, industrial REITs, what kind of properties are we actually talking about? Is it factories or?
No, think logistics. We're talking about a massive global portfolio of warehouses, distribution centers.
Okay.
And these aren't just random big sheds. They're strategically placed. Think vital distribution hubs all over the world, new ports, major highways, key logistics corridors, the real backbone of global trade and e-commerce.
Right, the places where stuff actually moves through. Now, I have heard Prologis might be a little, out of favor right now with some investors. Seems like there's worry about tariff issues, maybe broader economic jitters. How should a long-term investor think about that? When do those big macro worries actually start to matter for a solid company like this?
Yeah, that's the million-dollar question, isn't it? Look, those concerns are definitely weighing on the sentiment, no doubt about it. But what's really interesting is that the business itself keeps performing really well.
Okay, how so?
Well, take Q1 2025, for example. Their adjusted funds from operations FO, that key cash flow metric for REITs, it grew 10% year over year.
Wow, 10% growth. That's pretty strong, especially with those headwinds you mentioned.
Exactly. That kind of operational strength, despite the noise, it tells you something about the underlying business,
Definitely. And what about the dividend itself? Is it just holding steady, or are they growing it?
Oh, this is where it gets really compelling for dividend growth investors. They have a fantastic track record here.
Yeah.
Over the past decade, the average annual increase in the dividend, over 10%.
Over 10% a year on average. That's significant growth on top of the starting yield.
It really is. So you're getting that decent starting yield, plus potential for that income stream to grow quite nicely over time.
So wrapping up Prologis, sounds like a core industrial leader. Maybe facing some investor doubts right now, but the actual business performance and dividend growth are strong.
Pretty much.
So if you're okay maybe buying when others are hesitant, and you believe, global trade sorts itself out eventually, maybe Prologis looks like it's on sale.
That's certainly one way to look at it, yeah. For the patient investor.
Okay, let's switch gears completely. Let's talk Realty Income. This one feels different. It's the biggest in the net lease niche. Can you break that down? What exactly is a net lease? Why is it important for them?
Absolutely. The net lease is fundamental to Realty Income. So basically, they own mostly single-tenant properties. Think U.S. and Europe.
Okay, single tenant.
And the key part, the net part, means the tenant is responsible for most, sometimes all, of the property-level operating costs.
Like what?
Things like maintenance, building insurance, property taxes. Realty Income mostly just collects the rent.
So it's a much more predictable income stream for them, less hassle.
Exactly. Very predictable, long-term rent, minimal operational fuss for Realty Income.
Interesting. So what kinds of properties are we talking about in their portfolio? Is it all drugstores?
Well, retail is definitely the biggest chunk. And yeah, drugstores, convenience stores, dollar stores, quick service restaurants, things that are generally pretty easy to buy, sell, release if a tenant leaves. They like that liquidity.
Makes sense.
But they've branched out too. They also own industrial properties and this growing bucket of other stuff. Things like vineyards, actually. Movie theaters, even casinos.
Vineyards and casinos. Didn't expect that. Quite a mix.
Yeah, it's broader than people might think. Diversification.
And the yield here is much higher, 5.6%. It's noticeably above the market, above the average REIT, and like Prologis near the high end of its own historical range, too. Looks pretty attractive on the surface.
It absolutely is. That yield is a big part of the appeal, for sure.
Okay.
And to keep growing, even at their size, they've been adding more levers to pull, as they say.
Like what?
Well, beyond just buying properties, they're doing things like making debt investments, lending against real estate, and even offering investment management services to big institutional investors, finding new ways to generate income.
Okay, so they're finding ways to grow. But does being so big become a problem? I mean, it must take a lot to actually move the needle on growth when you're that size.
Right. That's a really sharp observation. And yeah, it's true. Their sheer scale means any single deal has less of a percentage impact on the overall company growth. It's harder to grow quickly in percentage terms.
So that's the downside.
It's a challenge for rapid growth, yes. But the flip side, the really good news for income investors, is that this scale, plus their sort of conservative management style, it makes them incredibly reliable.
Reliable how?
Think about their dividend track record. It's impressive. They've increased the dividend every single year for 3 decades now, and counting.
30 years straight of increases.
Yep. Now, the growth isn't explosive. It's more slow and steady. Think low to mid-single digits most years.
Right.
But for consistency, for reliability, it's really hard to beat Realty income.
So Realty income, it's like the super dependable workhorse. Maybe not the fastest horse in the race, but you know it's going to finish every single time.
That's a good way to put it, yeah.
Basically, if you want that rock-solid, reliable monthly income, they actually pay monthly, too.
Right. They do. They trademark themselves the Monthly Dividend Company.
Right. So if you want that steady monthly check from an industry leader, Realty income is kind of the definition of that. Almost a set it and forget it for income focus.
For many investors, yes. That's exactly the appeal.
Okay, third one. Let's turn to Simon Property Group.
Yeah.
Now, their main thing is enclosed malls and those factory outlet centers. Mostly U.S., but some overseas, too.
Correct.
But, we hear so much about the death of the mall. What makes Simon different? Why are they still a giant?
Well, that narrative is definitely out there, isn't it? But Simon's strategy is key. They focus specifically on the high-performing properties.
High-performing how?
We're talking malls and outlets that are leaders in their region, big destinations. They aren't the, struggling C or D-level malls you might see closing down. These are the A malls.
The ones people actually still want to go to for the experience.
Exactly. They appeal to that desire to shop, to browse, to spend time there, not just a quick transaction. And importantly for this discussion, they offer a pretty hefty dividend yield right now to 5.2%.
5.2%. Okay. That's attractive. But there's a catch here, isn't there? I seem to remember Simon has cut its dividend before.
That's a really important point to bring up. Yes, they have.
When was that?
Most recently, during the peak of the COVID pandemic lockdowns, when mall traffic just evaporated. Oh. And they also cut it back during the Great Recession, around 2008, 2009.
Okay, so it's happened twice in recent-ish memory. What does that tell us? Is it just too risky?
It tells us their business is definitely more sensitive to the economy. It relies on consumer spending, people feeling good enough to go out and shop.
Makes sense.
So yes, could cuts happen again in a really severe downturn? Absolutely, that risk is there. But here's the reassuring part, perhaps.
Yeah.
Historically, when conditions improve, that dividend gets right back on the growth track pretty quickly. We saw that after both of the last cuts. They rebuilt it.
So it's like
it
gets pruned back in a storm, but it grows back strong afterward.
That's a great analogy, actually. It rewards investors who can stick with it through the cycle, who have that longer-term view.
And what makes these specific properties, these high-quality ones, so resilient in the long run? Why do they bounce back?
It really comes down to that focus on quality. These big, attractive malls.
Yeah.
They draw in consumers, right?
Yeah.
Which means they also draw in the best tenants. The retailers want to be in those successful locations. And think about it as weaker, lower quality malls unfortunately close down.
Right.
These top-tier malls become even more important, more dominant in their markets. They kind of consolidate that shopper traffic and tenant demand. They become increasingly differentiated.
So the struggles of weaker players actually strengthen Simon's position over time.
In a way, yes. It reinforces the value of their high-quality portfolio.
So the bottom line for Simon: if you can handle a bit more ups and downs, that cyclical nature tied to the economy, it's proven to be a very rewarding dividend stock over the long haul, focused on increasingly valuable, high-quality retail real estate.
Precisely. It's a quality landlord in a space that's consolidating, but you need to be prepared for potential bumps along the road.
Okay, so there we have it. 3 really distinct REIT dividend giants. It covers quite a spectrum, doesn't it?
It really does.
You've got Prologis, maybe a bit out of favor currently, but a huge industrial player with that strong dividend growth record. Good for the patient type.
Yeah, growth-oriented, but requires some patience, perhaps.
Then there's Realty Income, the absolute definition of slow and steady, rock-solid, reliable monthly dividends. The tortoise, maybe?
The tortoise, exactly. High reliability, lower growth.
And finally, Simon Property Group, the high-quality retail landlord. Great properties, nice yield, but comes with that cyclicality, that economic sensitivity, though it seems increasingly set apart from weaker competitors.
Right. Higher yield, potential for good long-term returns, but you accept the economic sensitivity.
So clearly not all 3 will suit every single investor listening.
Not at all. They each offer something different, unique merits for different goals, different risk tolerances. It really shows the diversity you can find just within the REIT sector itself.
Yeah, absolutely. Which kind of leads to a final thought for you, the listener. Thinking about these 3 different profiles, the growth play, the stability play, the cyclical quality play, how might understanding these differences reshape how you think about navigating market dips? Or maybe how does focusing on a company's specific niche, like net lease or high-end malls, inform your wider financial decisions? It's worth considering which of these approaches really resonates most with your own long-term financial philosophy.